All right, let's jump right into this explainer. When a massive, highly anticipated IPO hits the market, man, it is so easy to get swept up in the hype. But today, we're going to look past the confetti. We're peeling back the carefully engineered theater of the IPO machine to see how the smart money actually operates. We're pulling all these insights straight from the latest Macro Butler newsletter titled The Last Buyers Club.
And it all starts with this one ultimate contrarian question. It's the question every investor has to ask themselves before buying into a highly publicized public offering. As the Macro Butler points out, when that opening bell rings and the TV bankers are screaming about a generational company, the really wise investor, they aren't clapping. They're counting the exits.
So here's our game plan for today. We're going to break down the grand IPO illusion, step inside the IPO room, look at history's mega IPO traps, spot the red flags and run rates, reveal the real AI trade, and then wrap it all up with the Macro Butler verdict. Let's get to it.
Starting with Part 1, the grand IPO illusion, specifically the ceremony versus the arithmetic.
We really need to contrast the public coronation of a new stock with the pretty grim math happening behind closed doors. You see, the financial media loves to sell the glamour of, owning a piece of the future. But we've got to ask ourselves, who is actually profiting at that opening bell? Because beneath all the silken ceremony, an IPO is, at its core, just a simple transaction.
And this idea captures the reality perfectly. The people who have literally lived with the company's numbers for years are turning around and selling to retail investors who basically just met the company over a quick marketing lunch. And they're doing it at a price the sellers handpicked. Now, it's not necessarily malicious, but as the newsletter calls it, it's just arithmetic dressed up for a coronation.
To see that arithmetic clearly, you've got to read the prospectus. The absolute most vital, and yet somehow most ignored, detail is the mix between primary and secondary shares. Look, a primary offering creates new shares to actually build the business. Fund research, build factories. That's honest capital formation. But a secondary offering, that's just insiders selling the shares they already own and pocketing the cash. If a listing is just absolutely stuffed with secondary shares, you kind of have to wonder, what do the insiders see that the glossy marketing deck doesn't?
Moving to Section 2, inside the IPO room, misaligned incentives and the cast of characters.
Okay, the absolute misalignment of incentives in this room is just fascinating. Think of every IPO as a stage play where the whole cast is working at cross purposes. First, you've got the sellers, the founders and private equity guys. They want top dollar because this is their big exit. Across the table are the underwriters, the investment banks. They're sitting in a gloriously conflicted chair because they get paid a cut to get the deal done, not to price it accurately. And then way at the back of the line is the retail investor. They're reliably handed the crumbs of the hot deals and, second helpings of the cold ones, usually buying after the morning pop at literally the absolute worst price of the day.
So here is the crucial takeaway. The entire process is engineered start to finish to extract your liquidity at the highest possible premium. The deck isn't stacked against you out of some dark malice. It's just stacked by design. The seller picks the timing, they control the information, and they completely engineer the first impression.
Up next is Section 3, History's Mega IPO Traps, the canonical trilogy of cyclical tops.
Let's look at history, because record-breaking IPOs are basically the ultimate contrarian mood ring. Take a look at these three magnificent companies. They represent this canonical trilogy of mega IPOs that flawlessly marked cyclical market tops. PetroChina in 2007, it debuted at a giddy valuation, becoming the first trillion-dollar company. The hangover was biblical. The Shanghai index cratered 70%, and PetroChina wiped out around $800 billion in value over the next decade. Then there's Glencore in 2011, listing at $60 billion. Skeptical traders were saying, hey, if the smartest commodity traders alive are cashing out, this definitely isn't the bottom. Sure enough, it marked the exact top of the commodity supercycle. Finally, Aramco in 2019 priced at $1.7 trillion. Just 3 months later, COVID gutted oil demand and Brent crude plunged below $20 a barrel. The lesson here is simple. None of these were bad companies, but a magnificent company sold at a delirious price by people who know exactly what it's actually worth, that's still a lousy investment.
Let's head into Section 4, red flags and run rates, spotting the illusions in the AI wave.
This historical context is absolutely crucial right now because we're staring down a massive incoming wave of AI IPOs from heavyweights like SpaceX, OpenAI, and Anthropic. So how do you protect your capital?
The Macro Butler outlines 3 very specific warning signs of an overpriced IPO. Number 1, a heavy secondary share mix. That tells you insiders are quietly sprinting for the exits rather than raising money to grow. Number 2, euphoric late cycle timing. The biggest deals need maximum market euphoria to get swallowed up, and max euphoria usually equals a market top. And number 3, leaning on flattering non-GAAP metrics instead of reality.
I really want to dig into that third warning sign for a second. We have to analyze why these AI architects love using metrics like run rate instead of just showing us audited profits. As the newsletter beautifully puts it, run rate is literally the native tongue of the late cycle. Companies use it to artificially inflate their valuations by taking one single really good month or a brief growth spurt and just projecting it out across the entire year as if it's a sure thing. It conjures up this massive, flattering valuation while totally sidestepping the harsh, unvarnished truth required by actual GAAP accounting. Bottom line, when sponsors lead with annualized or adjusted numbers, they are showing you the metrics that flatter them, not the ones that tell the truth.
Moving on to Section 5, the real AI trade. Moving from consumers to producers.
So look, if buying overhyped AI software at a market top is the trap, where is the smart money actually going? Check out this number, 1 gigawatt. That is SpaceX's projected compute power draw by early 2026. 1 gigawatt. This perfectly reveals the true macro current defining the decade. These companies going public aren't just software labs anymore. They are colossal eaters of energy. Because at the end of the day, an AI model is essentially just power transmuted into inference.
And because of that massive energy demand, the real trade is shifting your capital entirely. In every mania, the crowd throws all their money at the dazzling demand side and completely ignores the supply side, right up until they realize the tech literally can't run without power. The smart move here is rotating away from those overvalued consumers of energy that are floating at triple-digit multiples and moving toward the dowdy, undervalued producers of it. We're talking fossil fuel producers, nuclear operators, grid and transmission builders, and upstream miners pulling copper and uranium out of the dirt. Basically, the people keeping the lights on.
Let's get to our final section, the Macro Butler verdict, capital preservation in a shifting cycle.
Let's tie this all together with the ultimate verdict on how smart investors should be positioning themselves today. Amidst this massive equity issuance wave and with the world potentially sliding into stagflation, the structural advantage belongs to whoever prioritizes capital preservation. The focus absolutely must shift to the return of your capital, rather than just the return on your capital. The Macro Butler highlights that allocating to physical gold and silver remains the only truly reliable hedge against collective stupidity and reckless fiscal policies. Investors really need to move toward non-confiscatable assets with zero counterparty risk. Oh, and actively avoid long-dated U.S. Treasuries. They've essentially become an uninvestable, returnless asset class in this environment.
And for those of you looking to dive deeper into these kinds of contrarian smart money insights to help navigate this shifting cycle, you should absolutely reach out directly. You can contact the Macro Butler at info@themacrobutler.com and make sure to check out their website at themacrobutler.com.
Which leaves us with one final, pretty crucial thought to ponder. As this AI mania pushes the next wave of trillion-dollar valuations into the public market, the IPO machine is going to be engineered to make you forget that you actually have a choice, but you do. Ultimately, the most powerful seat in the house belongs to the person who reads the math, ignores the illusions, and just simply declines to play the game. So when that next mega IPO finally arrives, will you be the one ringing the bell or the one counting the exits?